If you're looking to make solid, medium to long-term investments, one thing you're going to need to learn is how to analyze a stock. One tool that's useful to do that is return on equity, or ROE. And today we're going to learn how to calculate it. Hi, I'm Sophia. I'm a financial marketer and a co-owner of a marketing agency. I decided to create this channel because since my maternity leave last year, I started to feel a little bit out of touch with the market, and I wanted to share my insider knowledge with you as well as keep up to date with the market trends as they come out. I make content at the intersection of finance, psychology, and family, so if that's something that interests you, follow along. I do need to say that I'm not a financial planner. I'm making this because I'm interested in the market and I want to share this with you and learn and grow together. Let's look at ROE, or return on equity. Return on equity is a ratio that indicates how profitable a business is to its shareholders. It measures how much profit is generated from each dollar of shareholder funds contributed to the company, or shareholder equity. There are 3 analysis levels for return on equity that we'll go into today, each more advanced and detail-oriented than the last. Most simply, at level 1, return on equity is net income divided by equity. Imagine you're choosing between 2 AI companies. Both earned $25 million in net income last quarter. Let's see which might be the better investment. Company A has $50 million in shareholder equity, while Company B has $100 million in shareholder equity. The return on equity equation for Company A would be 25 over 50, because they have $25 million in income last quarter at $50 million worth of shareholder equity, which puts us at an ROE of 0.5, whereas Company B has an ROE of 0.25 because they have more shareholder equity. Just using the return on equity equation, it looks like Company A is the better investment, but there might be more for us to consider, so let's keep thinking about it. Now, both income and equity are reported by companies each quarter or year. Income appears in the income statement, which measures the company's income over the year or quarter. Shareholders' equity, on the other hand, appears in the balance sheet, which is a snapshot of the company at the time of reporting. This means that it's not an accurate reflection of investment contributions over a full fiscal year or quarter. It's more accurate to take an average over the time that we're measuring net income. So, Level 2 allows us to do that by changing the denominator to average total equity. The equation for the second level of analysis becomes return on equity equals net income divided by average total equity. Let's return to the 2 AI companies. We look at both Company A and B's balance sheet for 3 quarterly reports and 1 annual report generated in the last year, and we found these numbers. We can see that the averages here are much closer than the denominator we used for the last equation. The return on equities are much closer as a result. Although Company A is still higher and looks to be the better investment, further analysis is required before we decide which is best for us. Finally, on the third level of analysis, we have decomposing ROE, or the DuPont formula. Decomposing ROE breaks down return on equity into key components to show which company operation is having the most influence or could be improved. I actually found this pretty difficult to understand the first time I read it, but then by the third time I read it, it seemed second nature and simple. So stick with it if it doesn't make sense, and maybe watch back again, or I'll link some resources in the description if you want to look a little bit more into it than we go into in this video. It requires more reading and maths than the last 2 levels, but we're talking about your hard-earned cash here, so the extra legwork is really worth it. At level 3, the equation is return on equity equals net profit margin times asset turnover times financial leverage. Why the change? Mathematically, we're adding assets and sales into our equations. The formula actually looks like this to break down each of these components. Return on equity equals net income divided by revenue times revenue divided by average assets times average assets over equity. The denominator and the numerator are actually the same in two of these equations, so that actually cancels out and becomes the level 2 equation that we looked at just before. The reason why we want to do the extra step here is because it gives us these 3 ratios, which are helpful for us to further analyze the profitability of a company and compare between similar companies. Let's look at what each of these are. Net profit margin is calculated by dividing net income over revenue. Asset turnover is calculated by dividing revenue over average assets, and financial leverage is dividing average assets by average equity. Just like shareholder equity, financial assets of the company or company assets are reported on the balance sheet, which means, again, it's just a snapshot in a period of time rather than an accurate representation of what the company might have over the whole period you're looking at. So if you're looking at what the company has had for income in the last year, then you probably want to get an average of the assets the company's had from the last year and the last 4 quarterly reports. Just as you would for equity, just as we did for equity in the last example. This level of analysis allows us as investors to see how a company is performing based on profitability, efficiency, so profitability, net profit margin, use of company assets, asset turnover, and financial leverage, use of debt. This is the same formula that professional analysts use and is taught by Harvard, which is one of the main sources for this article, which you can check out in the description if you want more information. If you were the owner of a company, decomposing ROE would help you to determine what areas of your company might need to be optimized. And as an investor, they help us to compare and contrast different business strategies of the companies we're looking to invest in. Let's now apply this analysis to a real AI company, NVIDIA. It'll help us to understand return on equity better and allow us to use this formula for other companies that we're looking at investing in. This is the SEC page, which has all of the filings for all public companies in America. There's similar pages for each country, so just go to whatever works for your country. I've searched up NVIDIA on this site and come to the page that has all the NVIDIA company information on it, and then you can just go straight into the annual and quarterly reports here and get all the information from these here. Because there's quite a lot of information we're going to go through today, I've added a little sheet into this for you. You can use this sheet to analyze any stock that you're interested in. When we're going through this example, it's going to be really helpful to have someone just to pop the information as we're going through and to keep us aware of what we're on right now. So if we just jump back, this is the annual report, the 10K report from NVIDIA, the last annual report that they did, which we're going to use for our net income and revenue. Another way you could do it, if you were going to be very specific about it, is take the last 4 quarterly earnings and then up to date, add those 4 quarters together for the income and the revenue. Just for this example, I'm going to do simple from the last annual report. We want to come down to the financial statements and supplementary data, and then we're going to go to the statements of income. Okay, so the statements of income, revenue is 130 billion and net income is 72 billion. So if we just jump back to our sheet, we can see the 72 billion in there and the 130 billion in here. Almost always in these sheets, the numbers are in millions. So that's why it's billion. So there we have the income and revenue. We need to also grab the shareholders' equity. The total 79 billion. So after we grab that, if we come to the balance sheets, we can see the total assets here and the total shareholders' equity here for this quarter or this year that we're looking at. And jumping back over to the spreadsheet, same two numbers here and here. I'll just run through this with you again for one more quarter. We're going to grab these two numbers from the most recent report, which is the 10Q. A little bit easier to go through the 10Q because it's a bit shorter. We want page 5, and then total assets 125 and total shareholders equity here, which again you can see those same numbers in the shareholders equity and assets columns. Once we have populated all 4 quarters plus the net income and revenue, we can see the net profit margin, asset turnover and financial leverage populate. If you were analysing, the 20 stocks from the same asset class that you were trying to choose between, having this sheet would be really helpful because it allows you to directly compare the profit margin, asset turnover and financial leverage of each of the companies you're considering going into and see what they're using in their strategies to get ahead. Then you as the investor can decide if that's something that you think is strong for the future. We can also see that the return on equity has populated up here. Again, if you are comparing multiple different companies, then it would make a lot more sense to have them all stepped out here for direct comparison. This sheet is in the description and free for you to use, so if you want it so that you can compare and contrast different stocks and their key statistics, you're welcome to use it. That brings us to the end of this video. Thank you so much for watching today, and I hope you got some value out of it. If there's anything that you want to add, feel free to comment below. I'd really love to hear from you. I found this super interesting this week just to get a better understanding of some of the calculations and statistics that I had been using for the last little while, and help me decide if I'm actually interested in using them or not. I recently did a video on budgeting, so if you're looking to invest but you're not really sure how much money you should be investing / where the rest of your finances are, definitely go check that video out. It'll help you figure out how much money you should be putting into investing and really kind of take apart your finances as they are right now before you can proceed further into investing. Thanks for watching. Bye.